Hello, this is Kath Hall and welcome to this eCPD module. This module on holdover relief, or gift relief if you prefer, will enable you to understand when the relief is available to individuals and its effect on relevant transactions. Holdover relief is available when a qualifying person makes a disposal that qualifies. Looking first at qualifying persons, this screen shows that it's primarily a relief available to individuals, and that's the aspect we'll focus on in this module rather than trusts. We're looking at people who might otherwise pay tax on the gift of an asset, as a gift is a disposal with the deemed proceeds equal to the market value of the asset concerned at the time of the gift. But as the donor, you've received no money, so a relief is provided to defer the tax that would otherwise be payable. This and the next few screens list the types of qualifying assets for holdover relief. In the past, the relief was widely available on all sorts of assets, but the qualifying list has been pared down to what we would now think of as business assets, but in a few different forms. At the top, assets used within a business, the donor's own or their personal trading company, which essentially means a 5% holding, or within a qualifying group. More of that later. The point about agricultural land, that's land that qualifies for APR under the inheritance tax rules, and then shares, going towards the bottom of the list, that are unlisted or where the shareholder is at least a 5% shareholder, i.e. it's a personal company. The graphic here is easier to depict a farm rather than the concept of a share, so bear with me. Just to interrupt the list of qualifying assets, just for this one screen. Now that we've talked about assets used in a trade, if an asset is used in a trade, but not agricultural land in the context of what I'm about to say, if the asset is only partly used for trade purposes, for example, a flat above a shop, or the asset is only used part of the time of ownership in the trade in question, there will be a proportionate restriction on the holdover relief. Now, for using an asset partly for trade purposes, it will just have to be on some just and reasonable basis. I've put a graphic which says A over B, which is a more formulaic way of looking at use of the asset only part of the time of ownership for trade purposes. Back to the list of qualifying assets and the two final IHT related circumstances where the asset in question qualifies. The circumstances are the determining factor, not the essential nature of the asset. At the top, therefore, any asset where there is an immediate IHT charge on a gift, so a gift to a trust, except in a few circumstances, and then gifts that would be chargeable without certain IHT exemptions. These are not the common day exemptions like the annual exemption, but specific ones, for example, heritage gifts, so a more specialist area. On to the nuts and bolts, the operation of the relief. This is a reminder that the holdover or gift relief defers the gain, effectively transferring the tax burden to the donee by reducing the value of the asset transferred for capital gains tax purposes. The gain will crystallise on eventual sale unless maybe another CGT relief applies. However, there may be certain sales at undervalue that will also trigger the availability of holdover relief. In this case, there will be some proceeds received, and those amounts received in excess of the original cost of the asset are chargeable immediately, and then the balance may be the subject of the holdover relief claim. This is reiterating what I said a little preemptively on the previous screen, looking at a sale at undervalue that still can attract holdover relief, and to re-stress for the examples coming up, the proceeds received in excess of the original cost of the asset are subject to tax immediately. The remainder of the gain may be subject to a holdover relief claim. And now some examples. This first one shows the use of market value of £28,000 in computing the gain on the unquoted shares in Carroll Limited. Whilst this is a relatively straightforward calculation, it emphasises the fact that holdover relief is a choice and requires a joint claim, without which the capital gain of £27,000 would arise for Andy. It may be not appropriate for a claim to be made, and Andy will crystallise the gain. Maybe he has capital losses, current or brought forward, that can be used in conjunction with his annual exempt amount, rather than agreeing that the tax burden essentially passes on to the donee with their possible tax consequences in the future. Again, this is a very simple example where Kevin makes a gift of unquoted shares in Noble Limited. They're unquoted, so are qualifying assets in a trading company, so tick that box as well. We're given the market value of the shares and the gain arising, and therefore you can see where a holdover relief claim is made, the gain effectively goes away, deferred against the base cost of the shares for his son. In this third example, John receives consideration now for the transfer of shares, again unquoted shares in a trading company. The amount received less the original cost, which if you look at the figures must be £5,000, so 7 minus 5, £2,000, is chargeable at the time of the transaction in March 2018, and the balance of the gain is the subject of a holdover relief claim. I'll come back to the residence status for the donee shortly, but just dropping down a bullet point, as this relief effectively shifts, as we've seen, the burden of tax from person to person, there must be a joint claim between donor and donee, except with regards to trusts, where only the donor has to make a claim. Back to the residence, gift relief, it's not a typo, is normally only available if the donee is UK resident. They're the ones that are kind of running away with the gain tucked under their arm, which is going to crystallise when they sell the asset. So you want to be within the CGT net as a donee from the HMRC's point of view. In addition, gift relief, holdover relief, interacts with the rules regarding non-resident CGT. Those that extended CGT to non-residents with regard to UK residential property, if you remember. Gift relief, holdover relief, is available. The assets are dragged into the holdover relief net, where there's a gift from a UK resident to a non-UK resident in those circumstances relating to that kind of property. I have reiterated the residence rule here. The donee needs to be UK resident. There is another point to be made. If the donee subsequently becomes non-UK resident, They could be seen as, using the language I used before, effectively tucking their deferred gain under their arm as they board the plane to Spain. That is the reason for the 6-year clawback rule you can see in the middle of this screen. There is a clawback of the holdover relief if the donee becomes non-resident within 6 years after the end of the tax year in which the gift was made, and the asset hasn't been sold yet, in which case the gain would have crystallised. There are some exemptions you can see in the bottom of this screen with regard to leaving to take up employment. I would just add that in the limited case of residential properties, the gain may be deemed to accrue at the time of disposal rather than the time of leaving upon election. The key things to remember from this module are: holdover relief applies to individuals and trustees on disposals involving qualifying assets, mainly assets used in a trade or certain shares, or where there's an immediate charge to IHT. The examples in this module show the application of the relief on a gift or a sale at undervalue and the effect on the donor and donee. The relief has to be claimed jointly by donee and donor and may be withdrawn in certain circumstances. I trust you have found this module on holdover relief informative. Goodbye and thank you for using Croner-i eCPD.